It's a flat start for us. We're not really feeling the heat from the global cues, at least to start off trade with. 19,570, I beg your pardon, is where the Nifty has started off on trade. Let's just revisit what are the stocks which are going to be in focus. Let's first mark what the crude sensitives are up to, because crude is now at a 10-month high because of Saudi and Russia extending their output cuts. So while it is good news for the likes of an ONGC and Oil India, it may not spell all that great for paints as well as aviation names. So those are stocks which are in focus this morning. This power grid as well, which has bagged a 20 gigawatt transmission system project from the state of Rajasthan, from the government, that is. There's maybe some relief on Vedanta. The Zambia government has returned one of the control of the disputed copper mines to the company. Vedanta holding up 2% right now. Bharat Forge, the North America Classic truck orders have seen an uptick of over 14% on a month-on-month basis. Mildly higher for Bharat Forge as we speak right now. And Voltas, very positive management commentary. They're aiming for a spot in the top 3 consumer brands. There's also a brokerage note as well. Motilal Oswal maintaining its buy with a target price of 1,000 rupees. Voltas now at 890, an uptick of 2.5% coming in. NBCC as well, which has bagged orders worth about 2,000 crore rupees. That's the other one which is gapped up 5% as we speak right now. What's Jio Financial Services up to? Already you're seeing block deals happen there. The stock a little bit under pressure. Remember, it's going to be out of the Nifty. And today in the last half an hour, you're going to see quite a bit of adjustments and outflows perhaps take place. 251.90 is where you are seeing Jio Financial Services. It's the last day that it's going to be part of Nifty 50. This Paytm as well, Vijay Shekhar Sharma categorically saying no plans to further increase stake after what he's already bought. That's the Anfin stake. Paytm starts off at 887 thereabouts. So that's pretty much what the trading construct is looking like this morning in terms of individual stocks. There's a couple of deal action as well. BKG, wherein the Lighthouse India Fund has sold 1.3% stake of the total 2.7% holding that they have. The Safari Industries, SBI Life has bought nearly about 1% stake in the company, wherein Investcorp PE has been the seller. So these are a couple of stocks which are also in focus. And then, of course, let's just check in on what HDFC AMC also is up to. Amresh Jena, who has resigned as the marketing head, maybe sentimental negative, absolutely flat on that stock as we speak right now. Let's check in on ABFRL, Petronet LNG, Jubilant Foodworks, the big buzzers and high flyers from yesterday. And still seeing some amount of momentum, at least on ABFRL. Petronet as well is a gainer in trade. And Jubilant Foodworks will just come up for you on your screens. 536, also seeing a follow through from where we left it off yesterday in trade.
All right, let's find out what our chartists make of the market open this morning. And Kunal, what's your takeaway given the fact that it seems to be flattish across the board? And what's the first trade that you will be punching in?
Yeah, so a flat start, but I think again an okay move from many of the large caps and many of the mid caps and small caps specifically. So I'll probably concentrate there. From the mid cap, Laurus Labs is something which looks attractive, trading at 400 plus mark, has managed to show signs of coming back about that consolidation. So that's the stock which I look to trade in the open.
Naresh, what about the first trades that you're looking at?
Continuing to look at NHPC as a buy on dips for the short term.
Right.
Let's just check in as to how things are trending within the small cap universe, because that really seems to be where all the action is. You've got near 0.5% up move there. Names like MMTC, NBCC, Sri Renuka Sugars and IDBI Bank, they're all a buzz. Add to that list something like Redington as well as Zensar Tech from midcap IT, and they too are holding out in trade. Let's get in a quick chart check going then. And Kunal, your view, Naresh rather, your view on MMTC as well as NBCC on the chart?
So I'll be a little cautious on MMTC because over the last many years, we've seen such spiky moves on the stock, and again, it drifts back. The stock would be a little careful here. We've in the last 2 years also seen that spikes of quick moves and then a fade off. So not really interested in MMTC, but NBCC is interesting. The stock has given a breakout. We've covered this before at 45-50 levels now. The high in 2021 was around the 60 odd mark. We've crossed above those levels. So that's a good confirmation of a longer term trend change and a continuation. Still remains a buy on dips. Going forward, would be looking at a target price of 80 on this one.
Right. Okay. Let's welcome on board then Ajay Srivastav as well and find out what he's making of the market texture right now. Ajay, hi morning. Good to have you on the show as always. Ajay, just wanted to understand, what do you make of the strength in the mid and the small caps and the disconnect with what the large cap universe has been doing? Do you think it's getting a little toppish when it comes to individual segments, at least within the mid and small cap universe? And is it time to tread with caution?
I keep saying this again and again, that India is a market of flows. I think that's where we are at this point of time, that the mid cap, small cap, mutual funds are driving this market into PE expansion. I don't think people are expecting them to grow very much, but the PE expansion is now getting into a zone which, hopefully the festive season will give one positive surprise to us. But if it doesn't, you could have a lot of grief sitting all there. Having said that, what is also happening is, over the last 3, 4, 5 years, so many companies have come into this market which have got new themes, new industries, unexplored sectors, that compared to the original concept of buying cement, bank, and those kind of stuff, steel, now people are buying different kind of set of companies which are primarily available only in the mid-cap space. So I think it's logical that the real growth stories are going to come from the mid-cap space, because those are the new sectors, those are the new companies, and therefore they can grow at 20, 30, 40%. Their large caps may grow at 10, 15% at the best possible thing. So I think it's not only the euphoria on PE expansion, which is definitely taking place, no doubt, but also that the universe of mid-cap companies has expanded significantly. I think about 400 good companies have come into IPO in the last maybe 3 years, and those growth is kind of driving the investment. Number two is new themes. How so defense took off last year has been a persistent theme. Capital good, phenomenally good theme, is doing very well in the market. Railway security scheme took off. Couple of stocks out there went ballistic and continue to be strength. The e-com, the new age companies are coming of age, so to say, and those become a thing. So I think it's a mixture. It's a lot of PE expansion, but lots of it is going that new companies, new sectors, new age. I think, and that is what is expanding the multi-cap universe and the performance that you see today.
You're not worried that it's getting frothy at the top?
If you worry, I think I would have died long back. Okay, I don't think you worry. I think you need to worry about that. Are you in the right theme which can ride through a phase of even a deflationary situation in the market? And therefore, if you are, in my view, if you are in the consumer space, I think you need to worry yourself. If you're in the automobile space, I think you need to worry yourself. If you're in the defense space, perhaps less of a worry. If you're in the capital goods space, definitely still less of a worry. So I would not say a sectors, but I would say that if you are in the right sectors, your worries are a lot less. Everything is expensive. Now, let's be clear about it. Everything is expensive in the market. But if you want to find relative safety, I think you need to go to segments which give you safety in terms of market liquidity, in terms of performance, in terms of theme, and the old regular companies. I think the cement and the steel and the consumer, I think those are the sectors one can leave them without that. Even if they perform at best, they won't give you above debt return. So I think you need to be sector focused, company focused. Don't worry about the indices, what happens to them, because that happens. And you saw what happened to an index of indices, the BSE, what happened. Price discovery took place, the share is going up, and you see what's happening to the share price.
Ajay, hi. So clearly that's a strategy that you're looking to maintain, and some of the sectors that you did flag off, I'd like to just, scratch those points further. Let's talk new age tech then. Where is it that you exactly would find comfort, or can you give us a sense as to what kind of companies, what kind of business models it is that you like?
See, we have, for disclosure, we have investment in largely three companies at this point of time. And each of them has a monopoly in its area. One, of course, is the delivery company. One is, of course, the financial services company. And one is the insurance online company. I think the three companies today straddle one of the largest segments of Indian market today. And they really don't have competition, really speaking, to a large extent. Sure, there is some competition in one delivery company. But by and large, they have now created a universe which is unbelievable and cannot be duplicated. It's like almost semi-monopoly taking place. And that's the beauty of this country, that we have a large country competitive, but we still have monopolies. And therefore, that you see in whether you talk of the payment system space, one company straddles it. I don't know, maybe before your age, there used to be a thing called Godrej Almiras. All the Almiras were known as Godrej Almiras. Today, when you look at it and says, paisa de do, the guy says Paytm kar do. Maybe he's using Paytm, maybe he's not using Paytm, but it becomes like a generic phrase. So I think that and then insurance aggregator, this company as well as delivery company, I think represent a trifecta of phenomenal value which will come from them over time. Yes, they have recovered from the valuation. Yes, they could be expensive still because they're almost at the break-even stage. They haven't reached them, but you can't take away from the ecosystem they have created. It's not going to be easy for anyone else to come in the space. And therefore, if you look at this troika of new age companies, I think they are the trailblazers and what is going to come with many more such companies joining in.
Sure. You talk about staying put when it comes to railway safety as well as the defense sectors, Ajay. But what about those who are looking at fresh investments? Do you think the time and the value on the table is not right, perhaps?
This is a constant debate we have in our office that when some of the older people come to the table for discussion investment, they say, but this share was available at this price. And the new guy, the trader, comes in and says, but you know what? I have bond today, so I need to look at today's price. I think this debate will go on forever and ever, whether, we are entering at the right price. The key point is, are you still in the segment? That is one. Number two, do you have ammunition to buy in when a correction takes place? Corrections do take place, 100% they will come. Prices, same share will be available 20% lower. The key question to yourself is, would you have the money to buy these shares when this correction happens? And I think that's where the process, it's not about whether you should buy or not. I think if you're in India, if you don't buy defense space, I think it's quite a dumb idea because for next 30 years, India's defense requirement will be humongous. The domestic indigenous policy is for there to see. Therefore, you could not, you may have a 1 year underperformance because of share price, but you won't have a 10-year underperformance or 5-year underperformance. So I would still say defense sector, definitely it's a plus. No matter if you don't have it, you have to enter sometime. You can't wait. Only thing is, when you enter this time, just ensure you have firepower on the side, that when the time comes, don't chicken out, buy more. When, that's the key point. It shouldn't happen that you have invested everything and you're watching. In market, only the people who survive are the people of liquidity. If you are out of liquidity, you could be out of the market.
Do you consider yourself, Ajay, one of the younger ones or one of the older ones in the office when you have these discussions?
I always make the younger one win the debate because the older one comes with the baggage saying, oh, I saw HDFC Bank at 60 rupees IPO. I said, yeah, that was my grandfather's time. Okay, stop it. Now the guy has entered today. If you're starting your work today, you're saving today. You can't sit and say, the shares are available at this price. Live with it. This is the current reality. That's a key question is, you need to average down your holding price. And that's the most important thing. Don't leave the sector absolutely vacant and say, I will wait for a mega correction. But have the ammunition to come in and keep lowering your average price and hold some sectors over 4 or 5 years. Defense is one of them.
Talking about HDFC Bank, Ajay, what with HDFC Bank and Reliance Industries? I mean, they've just been non-performers.
See, the two different examples. HDFC Bank, I think, performed very well when it had the market regulation in their favor. No new bank licenses, no competition. RBI kept real interest rate dramatically low, and HDFC Bank ruled the roost at that point of time. So I think HDFC Bank phenomenon was part performance, but most regulatory. Today, the regulatory is different. Today, look at the number of banks. Just see 7-8 years back and today. The number of banks which have increased, about 30-odd banks have come in. The fintechs have come into play. About 400 or 500 or maybe 1,000 fintechs have come to the space. So therefore, the regulatory umbrella which HDFC Bank had, which it was portraying as if it's pure performance, has now disappeared. And the real HDFC Bank performance is now coming to the fore. And that's why investors are kind of not going to make any returns because the bank is slow. The bank is, and if you bank with HDFC Bank, I can tell you that turnover at the lowest end, which is the front end that you and I face, is so humongous that, I do not know how many relationship managers one would have seen in the last 12 months. So I think there's a huge turnover. There are huge service issues in the bank. The bank has now to compete in a competitive market. Therefore, the returns will be muted definitely. Reliance, on the other hand, has chosen to be in industries which are the worst profitable industries in the country. It said, I'm going to do Geo. You can do Jio, but you never made money out of it. You can do retail. Retail is an 8% EBITDA business on which you are investing capex. Now, if your interest rate in the market is 12% and your company you're investing has an 8% EBITDA business, how do you create value for shareholders? Yes, you can create scale, but can you create value? And I think that's the problem with Reliance shareholders. They're looking at a company which is growing bigger and bigger on debt, but they don't see value because the underlying business of the company, for 10 years, what they built up is an 8 to 10% EBITDA business, which doesn't give shareholder value returns, may give scale and size, but there are no returns for shareholders there. And I can tell you for the next 5 years, it will be the biggest underperformer again, because all their investment is going into an 8 to 12% EBITDA business, and that's not going to give you a shareholder return, and not in an environment of interest rates at 12%. Certainly not.
Okay, Ajay, that's sage advice coming in. We'll let you go on that note. Appreciate you making
Thank you
time
very much. You have a good day.
You too. Thank you so much for joining us today. And it seems to be a good day for the bulls. Now, not much to complain. Of course, you have ONGC, which is your top gainer at the index level. Cipla continues the up move. Other PSEs like Coal India, etc. doing well as well. You have Jio Financial Services seeing a bit of a profit booking or selling pressure on account of the technical adjustment that we're expecting. But a lot of action in the broader market. It's Voltas from the F&O basket, which is seeing a gain of almost 3%. The management did speak to media and talked about how they're looking at increasing the market share, expanding their product portfolio. That's working out well for them. And MGL and Indiabulls Housing Finance are some of the other names that we were flagging out earlier as well. But we have a special guest in the studio. Mr. Sanjeev Bhasin from IIFL joins us to talk to us about his top picks right now. Mr. Bhasin, hi. Thank you so much for making time speaking with us. Is it getting a bit more difficult to find gems and stocks and dark horses, as you call it? Because a lot of these stocks have seen a massive run-up already.
Yeah, morning Anisha, to you and Awan. Great to be in your studio. Well, it will always be a glass half full, half empty. Ask those people who are sitting and waiting for that inevitable correction. So corrections don't happen by choice, and money is not made by default. It is only made by staying invested. You rightly said, yes, there could be a lot of froth maybe on the mid-cap, but that is who's to answer. The type of flows you're getting into mutual funds are all directed towards that. Now, obviously, the best play is after Prime Minister Modi specified PSUs, you've seen defense, power and railways take off on a tangent. There could be a lot of froth, but that's what our job is, to find stocks which make money. And we still have two dark horse ideas which we'll give you. But I think now is the time for large caps to definitely outperform. Firstly, I am bullish. I think 20,000 is coming in this month itself. And you could see some consolidation stroke profit booking in mid caps.
The 20,000 this month itself, what's driving that conviction? We're at 19,560 thereabouts, Sanjeev, at the moment. What's driving that? And what do you think will take leadership?
So, Awan, the last 400 points are going to be very, very difficult.
Yeah.
And you know that. But look at the ease with which mid-caps are rising every day. It tells me the feeling of missed out is humongous. Global cues are extremely positive. You will have this, teetering on the bond flows and yields and a little bit of the rupee. But look at the underlying. Macros are at the best ever. And I think that it is going to be big boys. So, Reliance from the large caps, Apollo Hospital, ICICI are three names which we are very, very bullish. You can add a Tata Consumer, given that consumption and Starbucks will see a lot of traction with the G20 and the World Cup. One of my large picks, one of my mid-cap picks, Devyani, has hit a new high. But I definitely think Tata Consumer has miles to go. However, like I said, this is the time to start to get overweight on Reliance, Apollo Hospital and ICICI. Apollo Hospital is seeing peer groups which are getting listed and their market cap move up, whereas this stock has done nothing. I think Apollo is headed to 5,600. You've seen Yatharth and the new listing get oversubscribed many times. And I think that, the average revenue per operating bed, Awan, was 58,000 this quarter, which they are talking of 9% upside quarter on quarter or maybe yearly. So you can imagine the potential which insurance and health has given these hospital stocks. Hospital stocks are a no-brainer, so Apollo removes the roost. Reliance is telling you how it's encashing its other businesses, the verticals, what it's investing, the oil to chemical business. If you are re-rating ONGC, then Reliance has to be the next in queue. And thirdly, ICICI, the largest lender. Two mid-caps which are dark horses, and take it with a pinch of salt that mid-caps may be little frothy, but I think there is a lot of value. So if you allow me, I'll come out with those two names.
Please, let's go ahead and discuss
So
those
first
two
would be
items.
Tata Tele. Now Tata Tele is the erstwhile, when NTT Docomo and all that, it's gone past that. It is the marketing arm of teleservices on ICT, on AI, on cloud computing. It has an arrangement with Zoom. It has you name the digital part and Tata Tele is there. Secondly, Anisha, many years back, 18 years, 2005-7, Tata Elxsi used to be 35 to 50 rupees. Yeah. That's when I invested, when realizing what digital potential was, because Mr. Ganesh was an excellent CEO. Now, House of Tatas is something which I'm very bullish. Plus, you have three plays, TCS, Tata Elxsi and Tata Com, which don't have the, the retail focus. That is where Tata Tele comes in. So, it's an 88-90 rupee stock. I think this stock, the business is brilliant. It may take time, but it could easily be a doubler, tripler from here.
Okay, so Tata Tele is one of the doublers, and you had the other dark horse bet for us as well, which is that stock?
That is JP Power. Okay, JP Power last quarter came out with an EBITDA profit of 450 crore. The net profit was 110, and we know that there is a debt overhang, but it has 2,500 megawatts of power capacity, 500 in Bina and 1320 in Naigri, which are thermal, and 400 in Vishnu Prayag. Now, you cannot have power assets trade at 5,000 crore market cap, whereas NTPC now is the largest player and you can see the market. I think that JP Power is in the process of divesting some of the large assets. Plus, on the other hand, the holding company JP already has more than doubled in a week. So, I think JP Power to 15 rupees would not be much of a problem. And beyond that, it will depend on how fast the debt can be reduced or return on equity improves. But at 8 rupees, you can't get a better stock or better bargain, which is, which has got everything in it regarding power.
Any sectors, Sanjay, that you believe currently are looking undervalued?
No, slightly expensive stocks, Avan, like Jubilant, Devyani and Tata Consumer. But I will go with the brands. I want to take risk on these large cap stocks, which are expensive, but the brands are inevitable. And you can see from G20, the World Cup, the whole thing taking off. Secondly, don't undermine the potential of Paytm and PV FinTech. I think like Zomato has doubled, even these stocks can give you a 50% upside. I think that they are slightly undervalued. Even though they've run up from 450 to 850, they've fallen from 2100. So take that to be the benchmark now, the highs which were there, not the lows.
Okay, so that's the take coming in. Just before I let you go, Mr. Bhasin, your word on Voltas, because that was one of the stocks that you were positive on. Today it's doing quite well.
Well, you had to be discerning to buy it at 750 when there was talk of, excellent rains and so on. The humidity has come now. And I always held that Voltas is not a business only on consumer electricals. Anisha, they have a 25% market share in setting up electrical cooling towers in the Middle East. And that is gaining huge traction. Plus now with Mr. Noel Tata talking of that being one of the big consumer plays, I think this is going to 4 figures.
Okay, 4 figures coming in on Voltas. That's one of the bets that Mr. Sanjeev Bhasin had. And of course, the two dark horse bet are Tata Tele as well as JP Power. So on that note, we let you go. Appreciate you joining us on ET Now today.
Thank you.
So those were some of the fundamental bets coming in despite the run-up that we have already seen. But we'll let you digest those bets. For now, taking a short breather on the show.
So glad you like the apartment. And this is our swimming pool. पर इतने प्रेशर में कैसे जिएंगे?
Housing.com, जहाँ है मैक्सिमम प्रॉपर्टीज. Housing.com, पर से परफेक्ट. डाउनलोड नाउ.
Back with the market and holding out for the equity markets, but it's a flat day of trade. Within the broader universe, there are a few names that do stand out. And within the frontliners, just checking in on some of the winners in trade today. And leadership being seen in Cipla, ONGC, HDFC Bank, as well as ITC and Reliance Industries. But lots to chat about when it comes to Ceat. So let's connect with the management. Kumar Subhaya, who's the CFO, is now joining in on the show to talk a little bit more about the impact of the rubber price hike, as well as what the outlook is on their global businesses like the Sri Lankan plans. Thanks so much for taking time out. Let's begin by discussing the raw material prices, because there has been a slight increase in the rubber prices in the month of September. But I think for you, the bigger worry would also be that China demand seems to be coming back, which could affect international prices. What is your sense as to how you're looking at these raw material prices impacting Ceat?
See, in case of raw material prices, rubber prices have been, in the international prices have moved up by about $80 to $100 in the last month, which is what I think you're referring to. Okay, and what is bothering us a little more is the recent spike in the prices of crude oil. Okay, and crude has now crossed $90. It's at 9-month high. We hope it doesn't stay at the current level, and if it sustains at the current level, it will have some impact on raw material prices, maybe in the second half of Q3. Chinese demand so far has been weak in the commodities market so far. So evident from the quantum of purchases from China, particularly in the case of natural rubber and few other commodities. So in the event that picks up, it may have some impact on the prices of some of these materials. That's the way we see it.
Okay, you said so the impact of the raw material prices, if at all, will happen in the second half of Q3. So is it fair to assume that in Q2, the margins will be close to what we saw in Q1 itself, or how's the movement is expected to be in Q2?
See, we expect our Q2 raw material prices to be more or less in line with Q1, and maybe a marginal increase about a percentage. Okay, we still have one more month to go for us to clearly understand how the raw material prices have moved up. We are holding on to our selling price, because that is another important selling price of tires. That is an important lever that influences the margins. So we are staying the course as far as the prices are concerned. In fact, we took some small increase in the month of July in some other categories in replacement market. So we expect margins to be in that range as we saw in Q1.
Okay, what is your sense then when it comes to your outlook on the Sri Lankan business recently as well? Are you looking at some sort of a boost in tourism for Sri Lanka helping propel your business over there? Is there, are some of the concerns that were there now ironed out? Is business back to normal in Sri Lanka?
See, it's slowly coming back to normal. I wouldn't say that it has come back to normal. Okay, and in the quarter that went by, they were very close to about 60% of the volume that they had achieved, the business had achieved, say, 2 years ago, before the currency impacted Sri Lankan business. Year on year, there has been improvement. We are seeing improvement in the last 2-3 months, thanks to availability of currency for them, more tourists coming into Sri Lanka, and also more remittances coming into Sri Lanka. It also had some positive impact on the currency. The Sri Lankan rupee was close to about 360 to a dollar 6 months back, and it's currently moving in the range of about 310 to 320 level. So therefore, that's also another sign of recovery. Sri Lanka is still a small portion of our total business, and therefore any impact on Sri Lanka doesn't impact us that much. But we look forward to Sri Lankan business getting back to the normal levels of business soon.
That was about Sri Lanka, but coming back to our own, the domestic business itself, what's been the demand momentum on the ground been? Because, of course, when we're getting the monthly sales data, at least on the wholesale side, the demand has been quite strong ahead of the festive season. Is that something which you have been witnessing through your order books, etc. as well?
No, we have to break our businesses into 3 business segments. Okay, in the replacement segment, normally in September and October months, as we are approaching Diwali and Puja holidays, so generally there is a tendency for OEM manufacturers to produce more, and also in the replacement market, we generally see attraction. We are seeing that in the month of September in terms of our own demand forecast for the current month and the next month, but it is not very significant. Okay, and the demand increase that we expect it to be in the small single digit for the month of September and October, if you were to compare it to the same period of last year. As far as OEMs are concerned, I think I would say commercial category is stable. We are seeing some improvement in the demand from two-wheeler manufacturers and also in passenger car manufacturers. In case of two-wheelers, the comparison is more with the same period of last year where the base was lower due to lower demand. So from that point of view, they're growing, but they are still not got back to where they were in the pre-COVID period. Passenger car side, there is a momentum in the growth in the demand. In the international business, it's slowly recovering. Okay, quarter that went by in quarter one, we were able to grow. And there are pockets where the demand is still weak, but overall basis, we are able to see some traction in the exports.
Okay, fair enough. That's a word coming in on the overall domestic business as well and how things are shaping up on that front. But I also wanted to understand from you what the outlook is when it comes to your price hikes. Are you looking at that perhaps in any segment?
No, we did take in the replacement segment some price increase in passenger car and truck and bus radial tires. It was a small increase. Okay, and considering that we are seeing some increase in raw material prices, we will have to wait and watch whether that need to translate into the form of any price correction. Raw material prices have been stable for the last 6 months period, except a minor variation. And during the period when the commodity prices had a run-up of about 50% kind of an increase in that 18 months period, we were not able to pass on the entire incidence of increase in commodity prices completely. So therefore, there is still a gap. And depending on how the market takes it, like we have to manage this triangle of margins, growth, and competitiveness very responsibly and properly. So there will, as and when we see an opportunity to adjust the prices, should the raw material prices remain at the current level, we will certainly explore.
Kamal, the one predominant trend of late within the two-wheeler segment has been premiumization, right? And without getting into the specifics of it, we've all seen some new launches. Tell me, how is it that you're going to ride on this premiumization trend?
Okay, if you really look at overall our own two-wheeler volumes share, our share of business, particularly with respect to OEMs, is generally higher a higher range at the premium segments. So in the event the premium segment shows a growth higher than the overall category, there should be a favorable impact on us. There is, I think your question is overall whether there is a trend in terms of customers exercising their preference over the premium. Yes, I think there is certainly a shift in terms of people looking for an opportunity to upgrade their vehicles to a premium vehicles, which we are also seeing the way the OEMs are giving us the demand forecast. We are also seeing, assuming electric vehicles is also kind of a premium, particularly in the form of a pricing. There also we are seeing some traction. So we expect a share of premium vehicles business to move up, and we are also accordingly changing the configuration of the tires, coming out with some new set of tires, say on the motorcycle radial side, so that we are able to participate in that growth.
I just wanted to get a sense from you of how the market share increase is actually panning out, because in your Vision 26, you had talked about how for PV you want to increase it to 18-19%. CU was expected to jump up to almost 15%. Two-wheelers, of course, you have the leadership, but if you can update us what the market share currently stands for all of these segments?
In the case of two-wheelers, I think we expect our market share to be in the range of about 27-28%. Okay, there has not been any upward movement in the market share in the last 6 months as per our own understanding as far as two-wheelers are concerned. So therefore, we still have a job to do in terms of meeting our vision with respect to taking our two-wheeler market share to the stated level. As far as passenger car radial tires are concerned, we expect our market share to be in the range of approximately about 15%. Our endeavor over this vision period is to take it up to 18%. We are moving in the directions. A lot of strategic actions that we have taken in the recent period, all towards moving towards that kind of a market share. So in case of passenger car, it is moving in the right direction.
Okay, it's moving in the right direction, at least in the passenger vehicle segment. But you also had a capex plan in place, right? How's that panning out? Because the street is expecting that the earlier capex that you had done will start eking out and adding to the ROCEs as well. When do you expect the bulk of the capex to get over?
Okay, you're aware that tires is a capital-intensive business. So if we really have to grow, we also have growth plans in the strategy period in terms of achieving certain levels of growth. Market share increase will come when we grow our top line. And for us to achieve that top line growth, it is important for us to keep adding capacities. In general, the asset turnover ratio, in case of any investment that we make fresh, would vary anywhere between 0.8 and 1.5, depending on how you scale up. So we'll continue to invest. And we had bunched up multiple categories where we had to increase the capacities in the previous 5-year period. Progressively, it is our endeavor to keep looking at each of the categories and progressively add capacities instead of bunching them up. As far as the current year is concerned, I think our capex projection is about 750 crores. That includes our normal routine capex as well as project capex. Going into the next year, depending on how demand unfolds, we would be looking at our capex plans. So it'll be in this range, 750, 800 crores kind of a range is what we expect for the current year in terms of ending up with. And going into the next year, it could be in that 800 plus or minus 100, 200 crores, depending on how we see the demand for next year. For a lot of our categories, we have added capacities, and those capacities are sufficient for us to meet our demand, not only for the current year, but also for the coming year.
Mr. Subbiah, such a pleasure having you today on the channel. Thank you so much for taking the time out.
Pleasure is mine. Thank you.
Okay, that's the word coming in from Ceat. Let's just revisit what the stock price is up to. Started off mildly in the green and since then has seen a cool off, as has the market as well. Started off absolutely flat and actually is still flat only. Petronet LNG, that's seeing a good continuation from the move yesterday. Torrent Pharma is, scaling up quite nicely, 2.5% higher there. And then, of course, there's Coforge, which has spiraled up about 2.5%. The gas stocks, they're the ones which are in focus. They're the ones which are holding out as a segment. MGL, Gujarat Gas, both of them up good 2% as we speak. It's actually metals which are seeing a very big cool off after significant outperformance all through last week and even day before. Jindal Steel, Hindalco, Hindustan Copper, SAIL, Nalco, all of these stocks are getting battered down. We'll take a very quick break on that note. When we come back, lots more corporates and market chat lined up.
Welcome back. Well, the market is holding on okay as far as Nifty is concerned, but Railways has one space which has been doing quite well for itself. In fact, if you pull up the stocks of IRFC, RVNL, Jupiter Wagons, Seat Wagons for the last 1 month or 3 months, you will see a traction of anywhere between 30 to 50% in these counters, given the massive run-up and the interest that we have seen in these names. Jupiter Wagons is one of such company, and we have the management joining us on the show. Mr. Vivek Loya, the managing director at Jupiter Wagons, is with us to talk to us about that. Mr. Loya, hi, thanks so much for making time and speaking with ET now. Well, we understand that the most recent news flow is around the capital raise that you have done, the QIP route. You're looking at raising around 700 crore rupees. What's the objective of that, and through which players are you looking to get this capital fund raise happening?
Good morning. So the whole idea is that there is a lot of tailwind right now in the sector, and we are expecting sizable order books to come in over the next few quarters. So as we have kept on saying that we want to increase our wagon capacity from currently we are doing about 600 wagons. We want to take it to over 1,000 wagons a month, as well as we have recently entered the brake business in the railway space, And there also we see a huge opportunity. So again, we have joint venture partners there. So there again, we are looking for capacity enhancement, not only for the Indian market, but now we are looking to export to the European market. And finally, I think there's a lot of opportunity in terms of further backward integration in terms of wheel sets and other products. So I think it's a overall outlook from which we are doing the fundraise. And our idea is that over the next year and a half, to invest about close to 1,000 crores of new capex.
Interesting. Vivek, you mentioned that your order book stands at 6,000 crore rupees right now. Tell me, what's the visibility, considering you're now looking at expanding to the European geography as well? And what then is the revenue visibility? I mean, how much of the orders would be executed this year? How much next year? What's the timeline?
So the current order book which we have, we are looking to execute it over the next 15 to 18 months. That is what our timelines are. In terms of visibility, again, on the private space itself, there is a very strong demand which is still there for new cars. What we are seeing is that quarter on quarter, whatever we execute, we are getting additional order books. And railway is now going to be announcing and tender for about close to 50,000 odd wagons, which we are expecting anytime. So I think that again they want supplies over the next 18 to 20 months against those order books. So definitely there is a lot of traction in the sector. So it's about how well we gear up for the execution.
Right, and given that recently you had Texmaco surrendering their contract owing to the lack of capacity and the low margin business, what about you? Are there any challenges that you're witnessing in regard to execution or on the profitability front?
No, our model is slightly different. One is that we are much more broad-based. It's not only wagons, we are in the commercial vehicle business. Then we are also on the container side, we are on the braking business. And on the wagon side also, as I mentioned, we are very selective when it comes to order books. Our focus over the last year and a half has been on the private side of the business and on the execution. So I think this has been our forte, and due to our size and the backward integration, I think we have been very successful in doing the execution. Going forward also, I don't see much challenge on the margins. I think there is, as I've said, there's a lot of traction in the sector, and we expect sizable order books. So currently our main focus is to expand our capacity and on the execution piece.
And the capacity and execute well. But if I have it right, Vivek, the plans were also to perhaps get into the lithium-ion batteries and tap into the entire EV opportunity as well. What's the plan there? What's the kind of investment you're making? What kind of revenues we can expect from that?
Yes, so that is a very interesting space. So both on the commercial vehicle side and on the railway side. So on the commercial vehicle side, early next year, we are going to be launching our first commercial vehicle. It is going to be a truck with a 1-ton payload. And the idea is that over the next 6 to 12 months to launch a couple of more vehicles from a 3-ton payload all the way up to a 5-ton payload, because we expect that segment to grow significantly, and that is the last mile segment in the country, where currently it is all IC engines. The market is about close to 600,000 odd vehicles, and especially in the metro cities and cities which are densely populated, there is a definite shift, and there is a government incentive also to shift from IC engine to electric vehicles. So that is one segment which we are targeting. On the railway side, again, railway has been using generally the older battery technology. So the idea is to shift from the lead acid kind of battery to the lithium ion. So we are already conducting trials on the railway coaches. The trials are going to be completed by the end of the year. Plus, on the Vande Bharat also, we have received an order book from Siemens for the Vande Bharat. So there, as you're aware, the railway rolling stock population is huge. So I think once the trials are over, we expect a sizable demand to come in from that segment. But in terms of revenue projections on that segment, it's little early. But yeah, definitely we see a lot of opportunity and visibility there.
Talk about your margins as well, Vivek, because they're better than your peers at around 13%. But this level has also been persisting since the last 5 to 6 quarters. Are the margins expected to improve going forward, owing to the diversification and the high margin orders that you're gathering in?
No, so definitely going forward, we expect not significantly, but definitely we expect the margins to improve as the new businesses which we are diversifying into, especially on the braking side, and now we are targeting also export of wagons. So as and when these kind of businesses kick in, we definitely expect the margins to improve. But obviously, we are already much ahead of our peers, so we don't expect any significant improvement. But yeah, as the revenue size also increases, as we expand capacity and the revenues increase, definitely a small increase in margins also will have a huge impact on the profitability of the company.
Good to have you on board. Thanks so much for giving us a sense of how things have been shaping up, because this certainly has been a sector that has been the cynosure of all eyes in the markets. That's the management of Jupiter Wagons. But let's shift gears then and also address all of the news that is going on when it comes to the power demand in the country as well as coal imports. We've got Mr. Amrit Lal Meena, the Coal Secretary of the Government of India, joining us right now on the show. Thank you so much for taking time out, and let's begin by just talking about the overall outlook, because it's usually the dry weather, the rainfall deficit this year which has led to a surge in power demand, and that seems to have raised questions about the adequate availability of coal. Now, we have Coal India clarifying that they have ample stock, but can you just clear the air for us?
Yeah, you are right. Last about 1 month, the demand for power is increasing because of the long dry spell. But as far as the coal availability is concerned, all three ministries, Ministry of Power, Railways and Ministry of Coal, are working in close coordination and ensuring adequate availability of coal at all thermal power plants. We have stock of about 58 million ton at our mine end also, and we have adequate stock at the thermal power plant. The production of coal in all collieries, we are producing about 22.5 to 23 lakhs per day, and we have the capacity to produce more if it is required. So that way, as far as the coal production and dispatch is concerned, we are monitoring the situation and adequate availability is being ensured at all thermal power plants.
Sure. So, sir, are you depending on imported coal to cope up with the unusually high demand?
See, ours is a very vast country, and foremost objective is that there should not be any load shedding in any part, and also there should be adequate stock at the end of the year. These are the objectives. So keeping that in objective, certain areas which are logistically constant at far off places, there may be requirement. So accordingly, advices have been issued by Ministry of Power in continuation of the earlier existing advice. So all of us have sat together and this advice has been issued, but we have adequate coal at all collieries and also at the thermal power plants. In certain areas which are at far off places in the coastal areas, they are importing for the blending purposes. From April till now, almost at about 2 million ton per month have been imported.
Sure, no point taken that the main focus remains that there's adequate supply of coal to meet the power demand, etc. But what are you doing to ensure there's enough liquidity, and not just for the power sector but the other sectors as well, like aluminium, cement, steel, because these are two big consumers of coal?
See, the energy security of country is to be ensured. Therefore, production of coal from all sources, the Coal India Limited, Singareni Coal Company Limited, and the captive and commercial mines, we are ensuring that all of them produce to the full of their capacity. Whatever issues were there which were impacting the production, in close coordination with the state governments and all other stakeholders, are being resolved. Now, the rake availability is also significantly high. So, all of us are working in close coordination, and hence production and also the availability appropriately is being ensured.
So can you tell us how well prepared India's coal sector is to meet the growing coal demand? What are some of the medium to long-term plans in place?
We have long-term plans for the coal requirement for 2030 and 2047, and accordingly new mines have been planned. We have a plan for 1 billion ton coal production target for Coal India Limited. 52 new projects have been approved which are at different stages of implementation. Similarly, for evacuation of the coal, many new railway lines have been approved. 3 of them have been completed, rest are under implementation, about 10 of them. And to bring in first mile loading efficiency, also the environmental sustainability, in all our coal mines which are producing more than 2 million ton of coal, 67 of such mines are into operation. We have planned to set up automatic coal loading facility, mechanized coal handling facility. So 8 of such projects are complete which are into operation. Another 27 will be completed this year, and rest will come in year next to that. So we have planned massive capex into the coal infrastructure, which will not only result in the faster evacuation, but also will help in environmentally sustainable loading and transportation.
Sure. We also believe that you have plans of setting up thermal power plants as well. Could you give us the roadmap for that?
See, Ministry of Power has plans for year 2030, and in that plan 4 thermal power plants of Ministry of Coal are also proposed. One project is Ghatampur Thermal Power Plant being set up by a joint venture of Neyveli Lignite and Government of UP. This is in very advanced stage of implementation. It is expected to come in generation by end of this year. Another thermal power plant, big size, is proposed to be set up by Neyveli Lignite in Odisha at Talabira. Land acquisition and clearances thereof are being obtained, and the captive mine thereof has been made operational. It is expected that by this year end the tender will be decided and project will be set into motion. There are 2 another thermal power plants, one in Madhya Pradesh with the joint venture of Madhya Pradesh government and SCCL, and another in Odisha. They are in pipeline in different stages of planning and preparedness.
Okay, thank you, Mr. Meena, for joining us and talking to us about how the coal situation is in the country and what measures government is taking to ensure that power supply is not disrupted. A quick look at some of the stocks, because it's the energy names which are doing quite all right for itself. Case in point being Castrol India. The stock usually doesn't move that much, but today it's up around 6%. Look at a Petronet LNG. That stock is higher by 6%. And you also have a couple of these gas names, the likes of Gujarat Gas as well as Indraprasth Gas. Those stocks too are at least showing a bit of a momentum on the upside. So these are some of the stocks, but there are lots more lined up. But we'll take a short breather on the show. Don't go anywhere.